Hello, everyone. A very good morning to all of you. Thank you for joining us on a Sunday. I am Ankit Kanudia, co-founder and partner, SmartSync Services, a SEBI registered investment advisory firm. Mission Smile is our 1.5 year young initiative to spread financial education and awareness in the minds of young and passionate investors of India. Investing Karwa is one of the means for us to achieve that goal. In this initiative, we learn from the journeys of the smart investors who have spent decades in the stock market. Today is episode 3 of Mission Smile Investing Karwa, and I am very excited to welcome Mr. Abhishek Basumallick on our platform. Abhishek needs no introduction. He has been investing in equities since 2000. That's 22 long years of experience in the market, right? He has explored various facets of investing, including technical trading, F&O, momentum, cloning, and of course, long-term investing. He set up IntelSense as a SEBI registered research analyst in 2018, and in a short period of 4 years has helped so many retail investors grow their wealth. Recently, he has also started his PMS. So a big congratulations for that, Abhishek. Thank you, Abhishek, for agreeing to do this. You have already said a lot about your investing journey on the Value Picker Forum and a few other interviews as well. Hence, it is a challenge for me to ask something original that can add more value for our Mission Smile members. However, I'll try my best to keep this conversation as relevant as possible. We have broken down today's discussion in 3 parts on the basis of your journey in investing. Abhishek Basumallick of yesterday, today, and tomorrow. With this, just want to remind you again that after our session, we'll open up for Q&A from the participants as well. We'll start with an opening remark from your side, Abhishek, and then we'll move on to the questions.
Okay. Thanks, Ankit, for having me on your program. When you asked me to come, I think you mentioned that Professor Bakshi was your first guest, and to follow Sir is not a very easy thing to do. I've been very close to Sir for a long time now, and I've learned a lot from him. As I have learned a lot from many other people. But thanks again for having me today. And for all of you who've taken out the time on a Sunday morning, to listen to somebody, talk about their investing journey. Thanks for joining. And it just shows that the kind of passion that you have, in terms of investing and in terms of this discipline. So thanks again.
Thank you, Abhishek. Let's go straight away to the questions. So we'll start with some history. So my first question will be, so you have been in the market for over 2 decades. And my first question to you would be, how did it all start? Tell us more about the early years as to what you followed then and how much of that is still with you today.
So starting was very, interesting in a way, because I don't come from a family or a group of friends or wherever, people used to discuss stocks or anything like that. So stock market was something which was completely alien to me. In the year 2000, I got my first job. I started working in a company called, which is a listed company called Zensar Technologies in Pune. So that's where I started. And like what happens is we were a group of young engineers who got a job together. And one of my friends, in the first week of our orientation, training, etc., there are like a few of us who became friends very quickly, and one of those guys gave me a book, which was Robert Kiyosaki's Rich Dad Poor Dad. and he said, "Yaar, Abhishek, ye padh le. I mean, read this book, and it's going to, it's a great book." So first of all, I was a bit taken aback. Ki kaisa naam hai? What kind of name is this? Uh, then I took that book home, and I could not put it down. So I probably read that book in that within that evening to night. So by I think 2:30 in the night, I finished that book, and it hit me very hard because I had come from a situation where uh, my father was taken ill when he was about 51, 52. He had a massive heart attack, and he had to leave his job. So I had seen the ups and downs of a in terms of financial life, as well as what can happen if you are dependent on a single salary, right? So that was always there at the back of my mind, and the book was right, the absolute right book at the right time. So my mind was tuned into something like looking for a second income. So that was the kind of mind frame that I was in, and I could realize that, okay, immediately after reading the book, that okay, if I continue my job for the next 25, 30 years, I will make decent money. But what happens if something goes wrong, and I'm not able to work like my father if I fall sick, or uh, what happens if I'm sacked from the job or something like that, right? Then what happens? How do I earn a living? So immediately the thought that triggered was, I should have a side business. Now here I was, when somebody who had no money, no contacts, just got a job. How do you start a business? You can't start a business just like that, right? So the other thing that interestingly happened at that point in time was this starting of these online brokerages, right? And I used to walk back from office to the rented place that we had in Pune, and I used to see all these ads of Sher Khan and others. So I had no idea what Sher Khan was. So, and that time, even in office, now accessibility to a computer or internet was very low. So even my project manager had access to a desktop with an internet. All of us, the rest of us, we did not have. Luckily for me, my project manager used to take the office bus home at 6 o'clock, and I used to stay next to the office. So I asked her, permission, that uh, can I use your computer after 6? And she was very gracious and kind, and she allowed me to do that. So I used to spend a lot of time studying about programming, which the work that I was doing. Plus, I used to spend 2-3 hours every day, every evening rather, in learning about investing. Because what I figured was, this is the only way out. I mean, I started with 5,000 rupees saved from my salary. There's that's the only way you can get into a uh, so the option that you had by reading Rich Dad Poor Dad was, either you are a salaried employee, or you are a businessman, or you are an investor, or you are a professional. Right now, I was a salaried employee, so the only other option remaining for me was either to become a business person or to become an investor. A business person was ruled out, so the only other option is investor. So you start thinking about reading. I had no background and no finance knowledge. I did not even know what earnings per share meant. So then the journey started of reading. So started reading Business Standard and Economic Times, and Business World, the magazine. Why Business World? Because that was the only magazine that was available for 5 rupees at that time. It was a weekly magazine for 5 rupees. Everything else was, I think, 10 rupees, if I remember correctly. Or Business Today, Outlook, Business, and all of those were 10 rupees, 15 rupees. Business World was only 5 rupees. So, you start with Business World, and started reading. Initially, everything went over the top. कुछ समझ में नहीं आता था. But slowly, knowledge started compounding. You start learning a little bit. and you started experimenting, reading research reports from the brokerages. That point in time, there were very few options to study also, right? Either you had books, Warren Buffett books. So the first book I read was The Warren Buffett Way, Robert Hagstrom's. Then chanced on to Peter Lynch, One Upon Wall Street and Beating the Street. I still have a hardbound original US version of Beating the Street, which I bought in MG Road in Pune, in a second-hand bookshop. But it was a new but old book, and I bought it I think for 25 rupees at that point in time. I still have that book. So started learning. So everything that I was reading was new learning for me, and I always had this problem that I thought that I don't know anything, so I need to work extra hard. And I started reading everything that I could get my hands on. Whether it was personal finance, whether it was stock markets, investing, long-term investing, trading, and I tried experimenting also. And the good part was I did not have I did not have a lot of money, right? So that was a major advantage, uh, because once you have a lot of money, you become fearful. Initially, you don't have knowledge, you don't have money. It's you're in a happy state of mind, and that's how it all started. I mean, basically, Rich Dad Poor Dad pushed me into uh, getting into investing. The circumstances were there, the context was there, because online brokerages was there, and I also then I was in an industry where access to internet was there for learning and for doing the trades and all that. Because had all these three things not been there, I don't think it would have worked out well. Because, for example, if I was doing some other job, maybe if I was working in Hindustan Lever or Tata Steel or something else, where I was not in front of a computer, not having access to internet, I don't think it would have started off at that point in time. So that's how the journey started.
You skipped one part of that question where I said that tell us more about, as in, how much of that is still with you today, as in the early. So we evolve as an investors, right? So something which you maybe picked up in the early two,
No,
three
so
years, 4 years.
so basically, all learning is incremental, right? Even today, whatever you learned in nursery or kindergarten or class one, your ABCD, it is still required. If you ask, do you still use ABCD? Of course you do, right? But do you use ABCD as the way it is? No, right? You are using words, sentences, paragraphs. So you move on from learning ABCD. The first few years was learning ABCD, learning how to write sentences, how to read. Uh, am I carrying something from that period? Of course I am, right? But you then build up on your knowledge every year, every successful investment, every mistake that you make. The more you learn, the more uh, the the more different vistas open up for you, in a way. Different roads open up for you. The more different people you meet. And I've been lucky. I mean, last say decade, I've had the privilege of meeting some of the best investors in the country, learning from them, understanding their perspectives. Uh, so maybe 20 years back or 15 years back, I used to be very, I used to sort of think that trading karta hai, so the guy's a trader, so no good. Slowly, after a while, another problem okay, so before I continue, you will have to stop me if you think I'm getting derailed and going here there, because that is my problem. When the topic is about investing, I tend to keep talking, and you might not get any value out of it. So you'll have to stop me and bring me back on rail. Okay, having said that, coming back to what I was saying is, see, what happens whenever you're learning something new is that you get a new perspective, right? Now, initially, And even today, I mean, forget initially, whenever I talk to so many people, what I find is that very few people actually question or challenge what they read or what they hear from others, right? So, Buffett has written something, so that becomes the Holy Bible or the Bhagavad Gita, and you sort of just regurgitate that. Yeah, that is what it's all about. And you don't question the fact that, is what he's talking correct in our times, in our place, in our context? Is that correct? Or, is something different, or has something changed, or is something changing? So those are things that I continuously ask myself, right? And then you try to evolve your own thought process. You figure out from your own mistakes, or you, more importantly, you figure out from your own successes that what works for you, right? And then you keep sort of building up on that. It's like walking up a skyscraper. You take it one floor at a time. After a while you get tired, you wait. Then you try and see, okay, can I get an elevator up? Those kinds of things. So obviously you carry something from everything that you've learned over the years.
Sure. Fair enough. And don't worry about getting diverted or taking extra time. So we, in this particular segment, as in investing Carva, our first rule is that we don't stop our guests. So you are free to move as much as you like, because the more you will say, the more wisdom will be able to soak in. So, and anyways, the recording is the event is getting recorded. So if any one of us is having some commitment, they can leave whenever they want. But I'm sure most of us would want to hear you more. So don't worry about the time and getting diversion. So moving on now, as early investors, we all have our own role models and also a heavy dose of bias towards investing, right? So what were those early biases for you that you think you have overcome over the years in your investing journey? If you can explain with a few examples, that would help us understand it better.
So, first, I think first part of your question was about role models. Obviously, when I started in 2000, most of the literature, investing literature that was available was about Buffett and Lynch, and primarily the value school of investing, or the GARP school of investing. And that's how I also got started. It made a lot of intuitive sense, to buy into good businesses that can keep compounding. So that's how, that was the kind of investing style that I also started with, and a large part of it I still continue to do. Initial years, I think in India, I don't know if any one of you remember, especially people who've been around for a long time might remember that Ramesh Damani used to do a chat on Rediff. I think if I remember correctly, it was every Tuesday at I think 4 o'clock or something. He used to do a live chat, and for people like us who were, absolute novices, to be able to ask questions, even though it was a online chat forum, it was something like mind-boggling, because there were very few, options to interact with, big name investors or people who, you looked up to. So I think a lot of learning from Ramesh ji at that point in time, early formative years. Uh, See, the biggest learning that you will get is about fixing your mindset, right? And I keep saying this all the time. Investing is 80%. It's, if I look at, the 80-20 principle, uh, successful investing is 80% about managing your mindset and your thought process and your psychology, right? You and I both can buy the same stock at the same price, uh, you know, and come out with completely different results, right? Because I may not be able to hold on, my conviction may be less, I may panic and sell out. Whereas, you may not, you may be able to hold on, through thick and thin. right? People like giving these stories, Amazon kya kitna acha ho gaya last 20 years, a great thing. The problem is, if you look at the ups and downs of Amazon over the first, from 2000 to 2010, how many people would have stuck around? Right? Very, very difficult. Only in hindsight do you feel that you should have held on. I'll tell you my example. HDFC Bank, I bought my second stock, if I remember correctly, that I bought in my life. Maybe 10 shares, right? Uh, I sold after it went up 20%. Right? I bought Pidilite, the first few share, few stocks that I invested in. The first stock I invested in was Hindustan Construction Company, HCC. Second, sorry, I made a mistake. Second stock was Hindustan Liver, HLL. It was not Unilever at that time, it was HLL. Then HDFC Bank, then Pidilite. So these were stocks that I bought in the year 2000. Now, when I look back and I think that, okay, if I had held on to Pidilite and HDFC Bank since then, even if it were a minuscule number of shares and kept adding every few years or every 6 months, I would have probably had a much, much, much better outcome than what I did by trying to get 15-20% here and there. So the point I'm trying to make is that it is all about psychology, right? Identifying. So people put in 99% of their effort in trying to identify stocks. Lena kya hai bata do, right? The point is, lena kya hai is a very small part of the problem, right? Ultimately, you have to buy and you have to hold, you have to sit through pain, because markets are non-linear, right? Uh, it is not that you are going to get 8% returns every year. 1 year you will get 50%. Next year you will get minus 20%. You have to, it's like Marilyn Monroe, right? I mean, I forget who said this about Marilyn Monroe. I think she said it about herself, that, you don't deserve me at my best if you cannot have me at my worst. So the market is exactly like that. If you cannot sit through the bear market, you don't deserve a bull market, right? So coming again, I have digressed a lot and I've gone from where to where, I don't know. But coming back to your question, uh, I was lucky initially because I always had this problem, uh, that I always thought that I don't know enough because I don't have a CA degree, I'm not an MBA finance, or I don't come from a family where stock market investing is in vogue. I always thought that I did not know anything, so I read a lot, right? So I must have read over 2,000-3,000 books on investing over the last 20 years, maybe more, right? And I was lucky that initial few years I hopped onto some great books, uh, and I learned. I was lucky that I got exposure to behavioral finance very, very early. So what I learned was that, and I still see this problem with practically 99% of people. Our inability to sell at a loss or take a loss. Price anchoring. I'll sell when I get back my price. I bought it at 100, now it is 80. Let me wait. Let me see. It's so difficult to sell at 100. I mean, below my cost price. The stock doesn't know you bought it at 100. It doesn't care who you are, right? This is the most democratic setup in the world, right? Here, Rakesh Jhunjhunwala and you are no different. He might have more capital. You might have, 1/10,000th of his capital, or maybe one lakh of his capital. But ultimately, when in terms of percentage returns, there's no difference between you and Warren Buffett. If you can identify a good stock, you can get a 10 bagger, and so on and so forth. Right? I mean, there is obviously differences between Rakesh Jhunjhunwala, Warren Buffett, and us, but I'm saying figuratively, the difference is not as high as the difference between, say, a Sachin Tendulkar and me playing cricket. Right? Here, you genuinely have a shot of making it big, and I've been again lucky to have witnessed people including myself, life journeys where people who started, from typical middle class families have been able to get to a level of financial freedom. Right? So that journey I've seen so many people, get in the last 20 years. It's just mind-boggling. And I have now forgotten what you asked. So price anchoring. These are the major biases, right? Inability to buy, inability to buy at a higher price than you bought before. So averaging up, right? Everybody thinks that, I'm doing great if I average down. I think it's one of the most stupidest things you can do, right? Very, very rarely, I mean, unless you have extreme conviction, you should never average down, right? So these are mental biases. Cutting losses ruthlessly. You have to be very, very ruthless to cut your losses. So these things, I think I learned very quickly, right? I have, even today, I am very, very ruthless about cutting losses, even in my long-term investment portfolio, because to me, uh, it has always been that capital is sacred, because I didn't have a lot of money to start with, right? So you cannot afford to uh, get into a situation where you lose your capital, or you lose a very large part of your capital. So that is where I think it's very, very important to uh, fix your mindset first.
Thank you so much. So that is the beauty of wandering. So because you wandered into a different area, that the kind of answer we got to this question is simply superb for us. So moving on to the next question, Abhishek, what were your top early big hits that gave you the kick that this is it, what you want to pursue for the long term? As in, not just I don't want to know only the names of the stocks. More importantly, what were the learnings? So what went right? What and so if I have to paraphrase in Hindi, like शेर के मुंह में खून लगना, right? Where you get that kick that no, this is where I belong and this is where I have to. So if you can share
So
something
there were,
regarding that.
initially first 5-6 years, to be very honest, it was all grind work, right? I'm trying to learn. I Without understanding anything, I didn't know how to read a P&L. I didn't know what anything meant. I mean, I could understand revenue, profits, but beyond that, what are the difference between ROE and ROC? I had no idea. So everything was a learning phase, and after that, uh, you gravitate towards the larger companies because there was information about them, right? You get brokerage reports, you read through them, you understand, okay, what is happening, and that is how I started off. I also started investing through mutual funds initially, uh, so I could see, what stocks the mutual funds were buying, etc., etc. So that is how, the learning started. I don't think that initial first 3-4 years there were any big winners or losers, because primarily the game I was playing was not for fours and sixes, because I was not prepared. You're like a tail ender, you're trying to protect your wicket and you're trying to get ones and twos. But what I could figure out was, even from the first few years, that this is a place where you could make money, right? So you put in 10,000 rupees, that 10,000 became 12,000. Or, every month I used to put in 4-5,000 rupees from my savings. Uh, and you could see that money growing, right? 2003 onwards, there was this huge bull market. Uh, then you started feeling that, you can actually make money. In a year, I don't remember whether it was 2004 or 5, uh, my portfolio doubled, right? So that is when you start realizing that this is a place where you can make money. And second, of course, by that time you started listening to Warren Buffett and Rakesh Jhunjhunwala and others, and Ramesh Damani, and you sort of bought into that uh, the fact that equity can generate returns which are beyond returns that can be generated by other asset classes. So that conviction somehow I got early on, which helped me because I could feel that ultimately, because simple cheese, what I could understand is who makes the biggest money in the world. Who are the people who are there on the Forbes list or the Forbes list of billionaires? There's no salaried people who are there, right? There are only business people who are there. Right? So ultimately, it is businesses which make money, right? And how I, as a guy whose day job is writing some code somewhere, in a company, how will I participate in that business? So by buying 2 shares of Reliance, my feeling was, देखो सुबह सुबह मुकेश अंबानी अलार्म लगा के मेरे लिए काम करने जा रहा है. And that is true for not only that, but for everyone. I have 10 shares of some company, right? And that guy is every day morning he's getting up, fighting everything, doing exports, imports, whatnot. Sometimes even stealing tax, XYZ, doing whatever. He's doing it for me because I have 10 shares. Ultimately, I'm getting something. So that that was a mental framework that ultimately I am participating in a business, and I am a silent partner. I don't have any say in their running the business, but whatever profits, and even early on I could understand that pura profit मेरे को नहीं मिल रहा है. A large part of it will get siphoned off, or something will happen, right? I will not see the whole money, but whatever I am seeing, that also is much better than what I could have done elsewhere. So that is how you build that conviction.
Right. So I really liked your cricket analogy where you said that I was like a tail-ender batsman and all. So I think that is where investing is probably, as you earlier also mentioned, that it's one of the most democratized setup in the world. So if you compare with cricket, so a tail-ender batsman will never probably start opening the innings, right? There will be one or two outliers, that's a different matter, but generally you will never see a tail-ender batsman going up to say someone like number one or number two batsman. But that is where you can, as an investor, or we can, as an investor, we can always move up higher in the ladder. And be it Warren Buffett, be it Rakesh Junjunwala, or be it any retail investor, you can start maybe at number 11, but you always have the possibility and potential, if you have the inclination and you do the hard work and a little bit of luck, obviously, then you have the chance of moving up the ladder, which is not there in cricket.
No, so I will correct you, and I will add one more thing to 2 parts. One is, when you are looking at a cricket player, right, especially in the Indian team, or when you are seeing them, they are already formed, right? Getting into the top 15 in India means you are already at the top, right? Then you are already Rakesh Junjunwala. You have to see them when they started their career. So Rohit Sharma was a spin bowler, right? When he started off, then he became a batsman. His coach said, "Yaar nahi batting karo," so he became a batsman, so and so forth. And that kind of thing you will see for a lot of people, right? Roger Federer started, I think, playing football. Then he moved to tennis. So a lot of these kinds of things will happen. So it's not that in cricket also it cannot be done. Cricket also people change. The only thing is, when we see them, they are at the top of the game. Same as in investing. I mean, when you are looking at the famous investors, they are at the top of the game. But they would have also had a journey, right? They would have started somewhere. They would have tweaked their style. They would have done something else. So that evolution happens with everyone. That's the first point. The second point I wanted to make was, you don't need you said you need a little bit of luck. It's not that. You need a lot of luck, right? Because what happens is most of us, most people do not uh, appreciate how much luck plays a factor. But if you really think about it, you might do a lot of analysis and XYZ, but there could be two companies similar kind, and you know decide I will buy Satyam instead of Wipro, or Satyam instead of Infosys. When you are taking that decision, both are similar. After a few years, you figure out Satyam has gone to zero, right? So now, will you say that you could have done a better due diligence? What due diligence will you do? You can. So what I'm trying to say is, all of that, the gyan that we get on TV, right? All of that is nice to hear, but if you interrogate that gyan, you will figure out that a huge amount of you know uh, how would I put this? A huge attribute is luck. And why? And I'll add to this. I think you will probably get to the next part about my quant and all that part. But what is ultimately quant? It is a process. And now, why do you need a established process? Why personally I keep focusing on process more than individualistic things, is because the more you are looking at individualistic picks, right, you will find that even Rakesh Jhunjhunwala, how many really successful picks does he have in his entire career of the last maybe 40 years? You will not be able to maybe point out more than 5 great stock picks that he has had, which is probably made him a lot of money. The fact is, he would have picked 100 stocks, out of which 5 has worked. The rest has not worked. And that is true for nearly all of us. All the big money is made in a very few concentrated positions. What would have happened if, instead of say a Titan, Rakesh Jhunjhunwala would have bought something else, maybe a PC Jewelers or something. I'm just randomly taking names because PC Jewelers wasn't there when Titan was there, but you get the point, right? So what I'm trying to say is, luck is very important, and we should not we should consider that luck is a factor and try to, as much as possible, reduce its impact. If we disregard the fact that luck is a factor and we say that nahi chota mota hai, theek hai, lucky ho jate hain, then you will not be working to reduce that factor of luck. That is where process and process refinement and building systems come, because then you're trying to look at more of base rate rather than believing that I will pick the next Hero Honda, or I will pick the next Bajaj Finance or whatever.
Thank you so much. That was really wonderful. And yes, I completely agree regarding the point which you shared about luck, right? So moving on, Abhishek, my next question will be, so we have discussed about a few big hits which you mentioned. So there would naturally be a few big flops as well, right? So you have spoken about some of the mistakes, like you said that you had some great businesses in your portfolio, but you didn't hold on to them. But apart from that, or maybe even something in that sense also, if you have some examples to share as to uh, as we always say, right, that it doesn't matter how many books you read or role models you follow, the best learning comes from our own mistakes, right? So what would be some of those mistakes early on, maybe sometime between 2000 to 2006, 7, 8, that taught you a great deal?
So first of all, I've been lucky because I have never had very big losses, and for this actually I have spent a lot of trying to analyze कि loss क्यों नहीं हुआ, why did I not make big mistakes. And one of the first things, or one of the outputs of that analysis that I had was that I was, at least the first 10-15 years, I was very conservative in my investing. So I would not take slightly questionable bets. I would always buy good companies where you had a very clear visibility of growth, buying them at more or less moderate to reasonable valuations, and then you hold on to them. If you buy a good company and which is growing, and you hold on to them, there is very minuscule likelihood that you will make a mistake. Right? So that is how it got. But then I realized that, okay, how could this have been better? Now, the biggest mistakes were mistakes of omission. So stocks that I have studied, businesses that I understood, that I could see around me, but I missed. Right. So Page Industries was a very classical example. I studied the business, and again, I'll tell you why luck and etc. Is very important. So because I was working in an IT company, I had the opportunity of going to US or other foreign countries once in a while. So I was studying Page Industries, and I got very short 1 week, 2 week trip to US, and there I went to Walmart, and there I found that Jockey is a very mediocre brand. Nobody cares about what Jockey is, and here I was seeing that Jockey is a premium brand in India, and it's being sold at a higher price, etc., etc. So I came back with that mindset कि यार ये तो फालतू ब्रांड है, इसका it has no brand value. Whereas I could actually in reality see that these guys were selling at a premium, they were selling, their numbers were coming through, right? But that mind block, that mindset. So again, I'm trying to correlate the things I've already spoken about, right? So the problem with mindset, the problem with luck. Had I not gone to US, I would have probably easily bought and held on to Page Industries for 10 years. But once I went there, once I saw that this is a below par brand, it got into my head, and I was never able to then buy and hold. Same thing, this similar problem I had with Bullet, Eicher Motors. I could see that people who were joining my company, I cannot ride a bike, right? Because my parents, my mom was very scared कि accident हो जाएगा. So I learned driving a car when I was very young. So in fact, first after 1 year of being in a job, I bought a car for myself, and again that was from large part funded by my equity investing. Again, I've sort of digressed. The point I was trying to make is ultimately it is Eicher Motors. I could see that the car park in our office was getting filled with Bullets, right? A guy who was coming and joining, first month he was buying a expensive mobile phone, and this was a time when we were all using Nokia Symbian phones, but there are people who are buying more expensive phones, 10,000 rupee phones, where other phones were maybe 5,000-6,000 rupees or whatever. And second month they were going and buying a Bullet, and that was very visible. Yet you missed it, right? So these are things which even haunt me till today. That if you've not studied, if you've ignored it, that's fine. If you've studied it and then you've missed it, and you've missed a 50 bagger or a 100 bagger, that's a criminal offense. So those were, I think, the bigger mistakes, and those are mistakes which I regret, and I try to see where am I making the same mistake again. Where is it that the story is very apparent, and maybe I have some bias in myself which is preventing me to buy something.
Fascinating. Now I'll be shifting a gear a little because till now we were talking more on equity market and equities in general. But I wanted to now dwell upon something more personal to you. So you have been in a day job for a long period of time. And I think only recently you started being a full-time investor. So many of our Mission Smile community members also are like you in that sense, right? So tell us something about your time management and investing process. This is very important because what gets floated around in social media is that you have to take risks, quit job, start early in investing. And many young investors fall for that trap. And I'm sure you are much more aware than me on this topic of people listening to wrong advice and then falling for it and then paying up for that. Right. And you are one of the best examples of a pragmatic person approaching investing and financial freedom in a very practical manner. So I think it would be great if we can spend some time dealing this particular point as to how you uh, went out managing your time, both in terms of your office work and also in terms of putting in decent amount of time in terms of investing, and how it all went.
Okay, so the first thing is, uh, this might sound a little bit preachy, but hear me out. First thing is, don't listen to people on Twitter or Facebook or all that nonsense, because most people who are coming and giving a lot of gyan on social media are actually clueless. If you put a gun to their head, they cannot earn anything. A large number of those are sort of fake profiles. So who do you listen to? That's a very important question, right? On social media or whatever. So I'll tell you what I do. So my underlying philosophy is, everybody is an idiot. I'm using the word idiot in a very loose term. Don't take it very seriously. But my underlying philosophy, everybody, by default, you have to say that isko kuch nahi pata, ye aise fek raha hai. And then you follow that person a little bit for a few days and see yourself being proved wrong. That this guy seems to not be that much of an idiot that I thought. That is one. And second is, if that person is a investor who is in the public domain, look at the public track record. Right? Don't try to learn cricket from somebody who's never played the game. Right? You know, all great coaches have played the game. They may not have been international players, but you cannot understand the pressure of walking onto an Eden Gardens or a Wankhede Stadium, and you have 80,000 people screaming your name, and you are going out there to bat, and the other guy is standing across 22 yards, is like 6'7", Curtly Ambrose or somebody like that, right? So that pressure, somebody who's sitting on the sidelines or gallery will never know. It's only the guy who walks onto that pitch who will know what it means to be under that pressure. It is that guy who has bought a stock and that stock has fallen 30%, and then his hands freeze and he becomes clueless ki yaar karna kya hai ab, will be able to tell you actually what the game is. So that is one. Second thing is, don't be in a hurry to leave your job. There is no additional glamour in becoming a full-time investor, right? A lot of people feel pride. I'm a full-time investor. So what? I mean, what great thing have you done, achieved in life becoming a full-time investor? If you are financially free, and if you can come and tell me that, boss, today morning I wanted to watch Netflix, so I'm watching Netflix. I don't want to invest. I don't want to do anything. Tomorrow I want to go and sit in Masai Mara in Africa. I can do that. That is fine. But if you are leaving a job and getting into something else where you are as much a slave of something else, may not be your boss, right? But you are the slave of the market. It's the same damn thing. It is actually better off that you have a diversification of income stream to be in a job and to invest, right? So there is absolutely no glamour, there is absolutely no greatness in becoming a full-time investor. So that's the second point. Okay, practical experience I will telling you. I left my job about 3.5 years back, and I was initially first 2 weeks I was very happy. Then I started realizing that, boss, this is a problem, because I have the whole day I have nothing to do, and all my friends are doing something, either they're in office or they're running their own business. They don't have time for me. So what will I do? There's up to a point you can read a book or you can watch TV or something. After that you get bored. So it's not very the reality when it hits you, right, of post retirement, if I may call it that, is not easy. Retirement is not easy unless you have something very, very, you are passionate about, you are doing. Investing was for me something which was very passionate, which I was very passionate about, and I thought that, okay, this is something that I like doing, let me do that. I was lucky enough that over the last 15, 18, 20 years, I've been able to become a little bit financially free, so that I don't have to do anything. That, if you are able to get to, that is what you should try to do. But that has nothing to do with becoming, leaving your job and doing that. So that was the second or third point that I wanted to make. And let me try to remember what was the other question that you had.
So basically, I wanted to ask you as to tell us more about your time management, as to how much time.
Yeah. So time management when I was working was very simple. Office work you have to do. There is no option, right? Whatever is your office timing, it's never 9 to 6, right? It's probably 9 to 8 or whatever. In between, if you get half an hour, 1 hour, you can read up something. What you have to do, what I did was, one of the reasons why I was a long-term investor was I was looking for 2-3 good ideas a year, or maybe 3 ideas a year, which I could hold for 2 years, 3 years, 5 years. So once you have that, you don't have to do a lot of work. So evenings I used to come home and I used to read annual reports or do all that. Saturdays, Sundays, obviously spent a lot more of time. That was the first maybe 5, 7, 8 years. After I think 2010 onwards, I more or less could figure out that office work was taking a backstage. I was making more money in the markets. Plus, I was more interested in this. There's too much of politics in office. So that was also something which I did not like. And also, to be very honest, I could see my seniors in office, and that lifestyle was not something that I wanted to aspire to. That 22 days a month I'll keep traveling here and there, and it takes a toll on the body, right? I've done a bit of that later stage of my career, fair bit of traveling. First few times it becomes, you feel great, I'm traveling by air, going to different countries, staying in 5-star hotels, so it feels very glamorous. But after a point, all that also becomes par for the course. ठीक है, वही same खाना तो मिल रहा है. Initially, when you get that, for coming from middle class background, right, you go to a 5-star hotel, see this great buffet spread. you feel wow, you overeat. You do it for the first few times, 5 times, 10 times. After that, you like same cheese hai yaar, chodo isko. So those kinds of things started happening, and I could figure out that uh, I was more interested in investing. I was making more money that in this side of the fence, and that's when I started cutting down on my aspirations at office. So I said, "Okay, I'll do my regular 9 to 6, 9 to 7 kind of job, and I'll spend more time, in the evenings, over the weekend, trying to focus on investing." And that's what I did. So there's nothing. See, ultimately, there is this whole concept of time management is a misnomer in my mind. There's nothing called as time management. Ultimately, you have to have two things. You have to manage your priorities, and you need to manage your energy. If you are feeling energetic about a priority that you have, it means that it is aligned with your thought process. If you feel good about doing something, you will figure out a way of doing it. For people who like watching sports or playing sports, you will find that you will get a time, you will make time to do that, right? People, nobody has to come and force you कि नहीं या कि भाई खेलो आप जाके या ये करो, which whatever you enjoy doing, right? So people naturally gravitate towards things where their priorities are and where they derive energy from. So if you figure that part out, ki what I like, and you do that, pursue that, then that is never a problem. From an investor perspective, if you can spend even say 1 hour a day on the weekdays and maybe 4 or 5 hours on the weekends, so roughly like 5 into 5 hours on the weekdays, and 5 plus 5, 10 hours, so 15 hours over a week. If you spend, it's actually more than enough, right? But you then need to sort of like Stephen Covey said, right, you have to look backwards. You have to have the goal in mind. You know that, okay, I have 15 hours, then what is it that I should do? If you then feel that nahi main day trading karunga, to nahi hone wala hai, right? So then you have to see, okay, this is the time I have, what would be suitable for me, and then you work accordingly. Then it's not a big deal.
That's really helpful, Abhishek. So two biggest learning with from your answer, which I take from as of now, is that number one is regarding what you said about retirement, or how we think about retirement when we are having that as an aspiration, and how we actually behave or act when we have actually retired. So we also wrote a blog on this in 2019. I've just shared the link, and that is where we ended the blog with this particular comment, where the prime consideration for evaluating any retirement plan shouldn't be about when to retire and with how much money. A more important question to ask is what we want to do in our life which brings satisfaction to self and livelihood for our dependents. So that is the question which we don't try to figure out when we are in the quest of reaching the financial independence or retirement thing, right? That is number one. And number two, which you mentioned about, you don't actually need too much time for investment. If you spend, say, as you rightly mentioned, 10-15 hours a week, and if those 15 hours you have full focus without any distraction, and you can probably, as you mentioned, that you can go back and see how it has, keep on internalizing what I have done in the last 15 hours and what are my key takeaways. Your learning is much, much, much better than slogging in, say, 15 hours, 20 hours a day, and maybe you are still not having any track of what you are doing, right?
And see, the other thing is, when I started, or last 10, 15 years back, there were no the opportunities in terms of accessibility or access to information was also very less comparatively. Today, there are so many good advisory services, there are good mutual funds, there are so many good books, blogs, etc., videos that people are making. You need to, figure out that, okay, these are maybe 2 3 good people I want to sort of follow, uh, in terms of learning, maybe in terms of an advisory service. A lot of advisory services are there which are reasonably priced. If you are investing, say, uh, 5 lakh, 8 lakh, 10 lakh rupees portfolio, and you are adding a few thousand rupees every month, a lot of these advisory services come very cheap, right? If you follow some of them, at least the learning curve and all that improves. So, and again, caveat is I run an advisory service, but I'm not trying to sort of advertise or promote that. You can go to any advisory service. You can not even go for advisory service. It's not mandatory. I'm just saying that sometimes it helps. That was an opportunity that was not there when I sort of started. uh, there are very good mutual funds out there. There are a lot of very very good videos that are there on YouTube today. You just need to be able to learn. You have that mindset of learning, listening to good investors, uh, and automatic knowledge compounding is actually faster, better, and longer lasting than money compounding, right? uh, the more you learn, the more you figure out that your knowledge, your acumen, your understanding about subjects keep going up. So be in that mind frame that you want to keep learning. Returns to hota rahega.
Right. So moving on, uh, I don't remember the exact time, but I remember some time back you tweeted about keeping that much amount of money in fixed income securities that will take care of your monthly expenses. And only after that you started your journey as a full-time investor. Since you were already an equity investor for over a decade at that point of time, why did you have such a conservative approach here? And I'm not saying
So
it's wrong.
no,
As
I'll tell
Morgan
you the
House,
reason. So first of all,
yeah,
you have to be very clear that what do you want in life in terms of financial. I'm not talking about the philosophical aspect of it, which is something which interests me a lot, but maybe we'll keep that aside for some other day. Uh, but ultimately, what do most people? I mean, we come from middle class background, right? What do we want? We want a reasonably stable financial, cash flow will come. That much is required. Now, this idea actually was first seeded to me by a friend of mine called Abhik Mitra. Abhik also runs a advisory. He's much senior to me, but a very very good friend of mine. Uh, he told me that Abhishek, you when you leave your job, make sure that you never get stressed because of the market ups and downs. So I said, how to do that? He said, keep your money that you have to run your household uh, every month. Keep that money aside so that every month you get that. So you know that if I need 100 rupees to spend in a month, I get that 100 rupees either from my company or from a bank FD interest, which is secure. वो आना ही आना है. So that idea I liked because all my life when I was working, other than the uh, provident fund which was sort of forced, I never had any other uh, investment other than equities. Now I thought that okay, now I'm moving away from there to something where my income, my net worth is always going to be volatile, right? And there's going to be no income per se. So what do I do? So then I need a source of income where at the end of the month I get that interest, or I get that money to run my household. So that's why I put the money in FDs. Now you might question, or anybody might question, that the mathematics of getting your monthly income from an FD is actually very difficult because you need a very large amount of capital to do that. Now, my point is that till you get to that stage, you don't want to leave your job, right? Because you always need to look at the worst case scenario. What happens if the next decade India has a bear market? क्या करोगे आप फिर? आपने तो नौकरी छोड़ दी. You left your job, and once you leave your job post 40, no matter who says what, you will not get a job back, or you will get a job at maybe 60% of the previous salary. So you should plan with the contingency that you will never get a job back again. And what happens if the next 10 years is a bear market? Will you be able to survive? Will you be able to live comfortably like the way you think you should? Because you would have some aspirations in life, right? Your aspiration in life is probably not that I will sit in front of the computer and do day trading or swing trading and earn 1 lakh rupees a month. If that is your aspiration, maybe I'm not the right guy to talk about it. My aspiration was never that. So my aspiration was I'll do what I want. So that these are also gradual evolutions of individual thought processes, right? So today I am at a stage where I want to only do what I want, right? So maybe from yesterday I've been working only on a particular quant system, right? And it's sort of bugging me all the time that this is not working. I'm trying to write a code, it's not working. So I learned Python after I left my job. I didn't know Python before. I was a Java programmer. I've done CGI, Perl, Java, C, those kinds of things. I learned Python. I learned PHP. I'm trying to do Python coding. One part is not working since yesterday. I'm getting pissed off with myself. But that is the happiness of trying to formulate a strategy, trying to figure out all weather strategies that I should. So what is my objective? I want to make money, right? I don't want to become a professor in a college, or I don't want to become a pandit and give gyan on all places. I want to make money. Now, how do I make money? I want to make money irrespective of what the market does, right? So for that I need different strategies. Not a single strategy will not all work at all points in time. So these are things that now I'm trying to do. This thought process was not there 5 years back. Now I am trying to think about those things. So the point I'm trying to make is that your thought process will change every few years, and you'll have to go with that. For all of this, you need to have that mental peace that मेरा घर ठीक ठाक चलना चाहिए. वो कहां से आएगा फिर? So that is why being conservative. Some people ask me, if can I keep aside 3 years of my expenditure and then become a full-time investor. My point is, boss, who is put a gun to your head and said you have to become a full-time investor? If you enjoy the process, you can be a part-time investor and enjoy the process equally well. A lot of people who've been on Value Picker know Hitesh Patel, right? He's an MD doctor. He's also, he left his medical. He was a medical superintendent in a hospital. He left his job, I think a few years back, pretty much the same time that I left. He's a very, very close friend, very dear friend, sort of friend, philosopher, guide for me, and he's elder to me as well. But when did he leave his job? He managed this entire journey while being a doctor. He was a doctor. He was doing private practice and he was doing investing. So there's no compulsion for people to leave your job and do this full time. Make your money. Who's chasing you?
Right. And this particular question and your answer was very, very, very close to me personally as well, because I have been on the other side. So when I started, I with my friend and partner started Smart Sync services. We didn't have this kind of clarity in our mind, and we faced the consequences in the initial 3 4 years. Right. So that is why what you say makes much, much, much more sense to me personally than maybe some of the participants who have not gone through that other side of the story. So thank you so much for putting that
No,
out
so
very
see,
clearly.
ultimately, now, if you use common sense and you be a little bit conservative, right, then see, one thing to understand is the market is very risky. So now you are getting full time into a very, very highly volatile, risky environment. You don't want everything to be risky in your life, right? In your financial life. So you want some stability in some place. That is the whole point. So you have to, whenever you are working, your paycheck is your stability. Then you invest your money, let that money be unstable. If your income is unstable or coming from an unstable source, then you need some other external point of stability, which has to be fixed deposits or rental income or whatever. I mean, depending on your circumstances, your thought process, whatever. Anything which will give you steady cash flow. End of the day, the game is cash flow. Whether it is individual or whether it is company or whether it is country. Ultimately, cash flow is the reality. Everything else is more maya.
Right. So you mentioned about value picker in the last answer. So how important was so you also mentioned about Dr. Hitesh Patel. So he's also a value picker member, right? So so how important was value picker in your journey as an investor, and how important do you feel it is to have a network of good investors to bounce off your ideas? So that is part one of the question. And the second part is also, is there any downside to discussing your ideas with a group of intelligent people? So these,
So,
I've
okay,
asked
so
two questions in one.
so value picker has been the greatest catalyst in my journey till date. No two questions about it. Why? Because obviously the learning curve steepened very, very fast since we started. Uh, the moment you put up something, the whole idea of why do I see, I even on Twitter also, when I share something, the whole idea for me to share is two. One is it's a repository for me to come back, because say let's say I'm reading something, I get a fact, instead of putting it down on some notes, I'll tweet it so that I can go back to it and refer to it later. So that is one reason I do it. The second reason I do it is because there are other intelligent, smart people who are out there who will, give me a counter view. I think you are making this mistake. Yeah, yeah, आप सही बोल रहे हो. Yeah, somebody will come then and write, give some news about it, which I may not have thought, or those kinds of things. So, Value Picker as a forum, as a structured forum, has that opportunity at scale, right? So you write about a company, and then you have so many people who work in that particular industry. Some people who work in that company, right? Some people who understand that industry or that company very well, they will come in and pitch in, and you get to learn something new. So that learning curve is becomes tremendous. So that's the first benefit. Second benefit is, over a period of time, you get to know a lot of very, very super smart investors. In fact, I will not hesitate to say that some of my friends who are there on Value Picker are, in my opinion, the best investors in India today in terms of track record, because I know personal track records of most of these people, right? They will beat the professional fund managers and all the uh, great Gyani people you see on TV, hands down. It's not even close, right? So that is the level of performance that some of these guys have. Uh, Absolute brilliant people. Uh, and the advantage is you get the wisdom of the crowd. So that has been the biggest advantage, I think, for value picker. And what was your second question? I forgot.
So second
Last
question
question.
was, is there any downside to discussing your ideas
Okay.
with intelligent people?
So okay. So first of all, you should not discuss ideas with random people. You need to know who to discuss ideas with. You don't want to discuss ideas with people who are whose, first of all, whose time frame differs from you, right? So let's say you are investing for 5 years horizon, and there is somebody who invests for, say, uh, somebody who invests for 6 months horizon. There's no point in discussing, because the entire game is different. One guy is playing test cricket, the other guy is playing T20. There's no point in discussing ki strategy kya hona chahiye. So that's number one. Second is, you don't want to discuss with people who are uh, always in sync with what you are saying. Most of the time, people discuss with friends or others for confirmation bias. Ki nahi, I am saying this and I want to hear only positive things. So if you tell me that should I buy X, and I say yeah, हाँ बहुत बढ़िया है, then there's no point in having a discussion. The other person should be able to critique your thought process. The other person should be able to give you inputs plus or minus. Only then it makes sense. Right? And over a few years of doing this, you will be able to get a group of friends who are able to do this. Right? So, for example, I don't think I have invested without discussing with Hitesh Bhai uh, at least for the last 4 or 5 years. Even and our portfolios are very different, right? But I value his judgment. I will ask him, or I will tell him that Hitesh bhai मैं ये ले रहा हूँ, क्या लगता है आपको? तो he will say ये तो कचरा है, ये है, वो है, ये तेरे को ये नहीं पता, तू गधा है. तो and then vice versa, he will say that I am buying this. I said आपको क्या है, ये फालतू कंपनी है, ये नहीं चलेगा, वो नहीं होगा. So that kind of thing will happen. So most of the time I'll uh, uh, so we'll try to keep each other on our toes. There are other people who I talk to on a very regular basis, get to bounce off my ideas. They'll talk to me to bounce off their ideas. Yeah, something as simple as somebody will call and say, अरे दादा ये देख लो एक बार, अच्छा लग रहा है, आप देखो, देख के बताओ कि कैसा लग रहा है. So that is how in fact a lot of my ideas these days come from friends, and vice versa. Even if I work on something which I find interesting, I'll tell some of my friends कि यार ये देख, ये अच्छा लग रहा है. You find out if I'm missing something. So I think that has helped a lot. I mean, a good network of savvy, very good investors is perhaps one of the best things that you can have.
Right. Thank you. So that was more or less about the past. So as we discussed, we are now moving to the second segment, which is what you have been doing in the recent years. So my first question towards that would be, in the last few years, you have changed tracks, or rather, I should say, you have added more tools to your armory. Bonds have become an integral part of your investing journey now. And you have written a lot about it on your Value Picker thread, which is fascinating. You also said somewhere that you wanted to teach investing to your son, hence, this came as a natural choice for you. Many of our members do not know about, maybe they have not read your thread, or maybe they have not watched that interview of yours. So would request you to elaborate here as to how it all started, all your journey with bonds.
So it started about 4 years back. What triggered was, I was reading a book where they had listed the returns of various investors, traders, etc. Over a long period of time. And what I found was that here I was, sort of overdosed on Buffett. And I could see that, boss Buffett's performance on a CAGR basis is actually pretty mediocre. compared to other people who've played the game for over 15-20 years. So my cutoff was, somebody needs to be there in that game for 15 years or more. There are people who've made 60%, 70% CAGR over 15 years or more. And if you do the math, it will boggle your mind, right? So I could, and because I was well read, I knew most of these people and what kind of investor trader they were. So first thing that triggered to me was, Buffett's way, or the value investing way is not the only way to make money. There are other ways, and there are probably better ways of making more money faster. So never get fixated with one style of investing. So that was the first lesson that sort of opened my eyes. Similarly, at that point in time, I also started thinking that, okay, if my son was pretty young at that time, so I was thinking that if this guy wants to, grow up and he also wants to become an investor, what is the learning curve? He'll have to learn all that I have also had to learn, right? From scratch. There's no shortcut. So if I have to tell him that, this is these 10 things you need to know, what would be those things? So then I started breaking it down into a very simple step-by-step process. So what is investing all about? Investing is, you first have to do a universe selection. Now, universe selection means you decide what kind of stocks you will look at. So Warren Buffett calls it core competence or circle of competence. Basically, where will I look at to pick my stocks from? Second is actual picking of that stock, or how do you come to a particular stock idea? The next step is how much money to put in that idea. So I have now decided, okay, I will put money in Reliance Industries. But how much of my portfolio? 2%, 20%, 100%, how much? So that's the third question. The fourth question is, how long should I hold, or when do I sell? Basically the same questions. Now, all of investing or trading or whatever is basically these four questions. You have to answer these four questions. What is my stock universe? What will I buy? How much will I buy? And when will I sell? Now, can I write down as a process, or in steps, the sub bullet points, if I may put it that way, of each of these? So universe selection, can I say that I will invest only in, say, Nifty 500 stocks, or I will invest in these sectors? Write them down. Next, stock selection. So what are the kind of stocks that work for me? So I will look at stocks with good ROC. I'll look at stocks with less, less leverage, good profit growth, so on and so forth, right? So you write down 5, 10, whatever number of parameters, screening parameters. So that will throw up your which stocks to buy. Then how long will you, or then the allocation. The easiest allocation is equated. So if I buy 10 stocks, I'll buy 10% each, or I buy a 20 stock portfolio, 5% each. Then the next decision point is to start to kar diya 5% each. What happens if one stock keeps going up and then that becomes 25%? So then you put a upper limit for a stock holding, you put an upper limit for an industry holding, etc., etc. And those are things that you need to tweak. And finally, when to sell. So most difficult decision for people, right? When do you sell? You can sell based on valuations. You can sell based on business performance. You can sell based on stock price performance, etc., etc. Right? So no matter what you do, write it down. So this was the thing that triggered that if I write down these as rules and I hand it over to my son or whoever wants to come and learn something, right, who's coming fresh, then his learning curve will be faster. That ठीक है, ये करना है मुझे steps. These are the steps I need to follow, and then you keep refining that for what works for you. Right? So that is what quant is all about. It is just looking at quantitative numbers. So there you are not sitting and deciding, yaar, Adani ka management अच्छा है कि नहीं? Do you think that this company is going to grow for the next 3 years or not? That is not, there's no subjective judgment. You are looking at hardcore numbers and you are deciding, how will I decide quality of a business? Okay, parameterize it. And you say, okay, quality of business, I will look at promoter holding, I will look at ROC, I will look at debt, etc., etc., right? Or I will look at trends in these and I will decide on the quality of company. So there's no subjective judgment to say that, I don't like this guy, or I don't think that this guy is good or bad or ugly or whatever. You are basing your judgment on numbers that are there. So that is all, everything that is about, that is quantifiable with numbers is quant. A lot of people think quant means high frequency trading. No. Even Joel Greenblatt's magic formula is a quant system, right? Where you are buying and selling once a year. Every index, Nifty, Sensex, Nifty 500, these are all ultimately quant systems. There is no, stock selection committee sitting and deciding, nahi, Nifty mein ye stock nikalo, ye dalo. There is no stock picking which is happening. There is a formula based on market cap, based on volume, that is putting a particular stock inside a index. So ultimately you are basing your index entry into, you are doing it by numbers. That is what all quant is about.
I remember somewhere in one of your interviews, or maybe in any of your blog posts, you also mentioned that even the father of value investing, Benjamin Graham, he was also a quant investor. I would like you to elaborate
so
on that, because
Ben Graham was a full, he was a 100% quant. If you look at his initial years, all he was working on was nets and all that, right? So basically looking at balance sheet quantitatively. He was not going out and doing investing like the way Warren Buffett did, which was more of quality investing, looking at quality of management, quality of earnings, etc., etc. Ben Graham was just looking at statistical nets, arbitrages, those kinds of things. And if you read his interviews at the end of his career, before he passed away, you will see that he has been very categorical. He says that active fundamental research is pointless, because everybody in US is doing the same research on the same company. There is no alpha to be generated by doing that. The only thing you can do is you can use quantitative systems to basically get rid of your biases. Having said that, that is Ben Graham. The other person who very few people know, who's now become a sort of a quant. Although he will probably not like to associate the term quant with himself, is Sanjay Bhattacharya in India. Sanjay Bhattacharya was a pure out value investor. But if you listen to his recent lectures or read his writings, he now does only formula based systematic investing. It's not short term trading that he is doing, but he is doing it based on quantitative systems.
So many, including myself, have a very limited understanding of quants. In fact, if I have to talk about myself, I'm probably zero on quants. So even though we at Triple S follow fundamental rules of investing, we are always eager to learn about new things and see if we can incorporate them into our investing philosophy. So if you have to advise me how to go about starting from scratch in quants today, what will you say?
So
Part of it
exactly
you have
what
already answered.
so exactly what I just said. You have to start thinking in terms of writing it down as a process. whatever you are doing in fundamental investing today, write down that tomorrow if you have to hand it over to somebody who does not know investing, right, and say that just ye formula follow karo, what will you tell him or her, right? Just do that and see that you must be, everybody has some thought process in mind, right? When you are looking at a particular stock, you are coming up with ye acha lag raha hai. How are you coming to that conclusion? There's something which is going on in your mind, right? There is a pattern which is there. Try to write down that pattern. The reason why a quant system or a process based system is important is it is a self improving loop. See, in discretionary investing, what happens is you will get a lot of hits and misses, but there is very little you can learn from a miss, because people don't take the learnings and put it back into the process. In a system, you will be forced to do that. Ye galti hua, kyun hua? And how do I fix it the next time? So then you go and update your system. One good book that you can start with is Jim O'Shaughnessy's What Works on Wall Street. It's an old book, but perhaps the best book to get started on quantitative system-based investing. He's more a fundamental based quant system builder, one of the pioneers of quant systems in the world. There are a lot of other people you can read up on, AQR, Cliff Asness, Ed Thorpe's systems, but Ed Thorpe and others, they are more into shorter term period trading, whereas Cliff Asness or Jim O'Shaughnessy are more of investors, if I may call it. They have, in fact, some of them even have value investing quant systems also, value based quant systems.
So going further into what you have already said is, do you mean to say that non-discretionary is clearly better than discretionary? Or so let me just reframe this. So when we talk something about, say, techno-funda investing, so do you mean to say that a best form of techno-funda investing will be completely non-discretionary? Or you think that there will be some discretion?
So ultimately the thing is, what works for you? Because when the market is falling 5% every day, will you follow your system? If you read The Man Who Solved the Market, Jim Simons, he writes there that when the market crash came, even he was unable to follow the system. So he had to be physically, sort of tell his team that, don't listen to me, kind of thing. The point is that you have to figure out what works for you. There's no one easy answer to this question. Warren Buffett will never be able to become a good quant investor. His mind does not work that way. He will forever remain a very good quality moat-based investor. So this is like reaching heaven, right? There's no one way. There are a lot of ways. You have to figure out your way.
Right. True. So Rakesh Jhunjhunwala is undoubtedly the biggest investor in India. And even though he has earned a bulk of his wealth through long-term holding on to great businesses like Titan or CRISIL, but he also does short-term trading, medium-term trading. And I remember when I met you in your office in Salt Lake, Kolkata, you said something which reminded me of him. You said your trading portfolio, your quants portfolio, and your long-term portfolio are completely different. How easy or difficult it is to maintain that? And if you can elaborate more on this topic as to why you do that.
So I have heard that it is very difficult from others. I personally do not find it that difficult to do. So I am able to do it myself. The only thing is I have 3 separate brokerage accounts for different styles, and it's segregated that way. You have to your thought processes has to be different. For long term investing, you have to be able to sit through ups and downs. For shorter term trading, uh, your mindset needs to be slightly different. For quant, obviously, your idea is to build systems that are able to generate returns without your intervening in between. uh, so I mean, again, you have to compartmentalize your mind to be thinking of only one thing at a time. If you mix up your long term investing with trading, you will end up becoming poor in both. So this, I mean, the short answer to this question is you have to try it and see if it works for you. If you are not able to do, because see, the mindset has to be different. That's what I'm trying to say. In short term trading, if a stock you've bought at 100 goes down to 90, you have to get out dispassionately. If you're in a long term investment mode and you have very high conviction, if you're at 100, if it goes down to 90, you are, you're thinking, maybe can I add more, can I add a little bit more, right? So different types of thought process. In short term trading, you're looking for quick returns. The way you are trying to build CAGR is high turnover, basically. So it's like the difference is between a fine dining restaurant versus a McDonald's. Long term investing is fine dining restaurant. You go there, you are sitting there and you're eating for 2-3 hours, and they charge you a bomb at the end of it, but you get to spend 3 hours to sit there. Whereas in McDonald's, you go there and you are in and out in, say, 15 minutes. Right? So both those companies are making money. McDonald's is making money. That fine dining restaurant is making equal amount of money. The difference is, in the fine dining restaurant, it is high margin, low turnover. Here it is low margin, high turnover. Exactly the same thing in investing. If you think of it as a business, long-term investing is high margin, low turnover. Short-term trading, short-term investing, whatever you call it, is high turnover, low margin.
So before I move on to the next question, I just wanted to have your thoughts on this. So the time is already 12:45. So, and I have a few more questions, and also there are some really interesting questions on the chat box. So do we have extra time, or you want us to limit us to?
So for me, I have enough time. People will drop off after some time.
That's fine. We'll still get it recorded, and so many people who might get dropped off, they have the time to.
So one thing I can suggest is, let's go through the questions in the chat, and then we can come back to whatever questions you might have later.
Yeah, that's a very good idea. Yes. So let me just start with the first question. I think Ramnath has posted this question. Abhishek Da, your views on concentrated versus diversified portfolio with limited capital. What is the point in diversification if diversification on long run more or less match the index? One can might as well do passive investing, indexing, or be good with mutual fund.
My views on concentrated versus diversified portfolio with limited capital. First of all, you have to understand that if you are good at the game, you can be concentrated. Concentrated ka matlab kya hai? What does concentrated mean? In my book, don't get concentrated less than maybe 5-6 stocks, right? So minimum of 5 to 6 stocks, unrelated stocks in different industries is good enough to start with, and don't diversify more than 20 stocks. Roughly, I would say 15 to 20 is a good place to be. One of the reasons why I say don't over diversify is कुछ अच्छा निकल भी गया ना, you make a lot of, you make one good investment, it will not make a difference if you have a 2% allocation. Similarly, the holiest grail of investing is don't screw up, right? Don't make mistakes. Your probability of something going drastically wrong is if you have very high allocation to it, right? If you have a 40-50% allocation and that goes to zero, then you will be in a bit of a trouble. So 5-6 companies, 15-20% allocation in good companies, well managed companies, and still you have to keep in mind that any one of them can turn up like a Satyam, right? You don't know. That company may have been around for 50 years and then suddenly come out and say that, boss, last 10 years we've been defrauding you. And then what happens to your money? You don't get an exit also, right? So always plan or think about the worst case scenario and then go forward. Think about the worst case scenario and the upside will automatically take care of itself. What is the worst case that will happen? थोड़ा सा कम return मिल जाएगा. Instead of 40%, you'll make 30%. Instead of 30, you'll make 20. Instead of 20, you'll make 10. ठीक है, you'll not get killed, right? So that's the basic idea of concentration versus leveraged. You can definitely do indexing and mutual funds. Absolutely nothing wrong in that. I've always told and written about people who don't have the time at all. You don't even have time to study. You don't even have time to follow advisories, etc. Best option is put your money in Nifty 50 and Nifty Next 50. Make a basket, do an SIP and forget about it. You will make decent returns over a period of 10, 15, 20 years. Don't have to overcomplicate.
Sure. Thank you. So, Rohit, I'm skipping your question because whatever you have asked is already been covered by Abhishek in his comment on quant. Abhishek is asking, can you do a Jim Simmons in India? Have you tried his approach? Is it something like evergreen model you are working on?
Okay, so I cannot become Jim Simons in India because Jim Simons has the acumen and the brilliance to probably have won the Nobel Prize if he stuck around to it. I have not even 1/100th of that kind of acumen. That is the first problem. Second problem is that in India, data source is very, very limited and very difficult and very expensive to get. So just to get the data, and not only stock price data, fundamental data, macro data, is very, very difficult, right? I've started on that journey slowly. We'll see how long, how far I can progress on that. The other part is the evergreen model. I am trying different strategies. I have a momentum-based system. I have a mean reversion kind of system, but doesn't give very good returns. So my long-term investing is basically my mean reversion kind of system. I have a momentum system. What I'm now starting to think about is how do I make money when markets are bad? So basically a shorting based system or a bi-directional system. So a system which goes which is long when the markets are good and which goes short when the markets are bad. Unfortunately, in India, the only way we can do that is through FNO. I don't want to get a lot into FNO because I've seen a lot of people lose their shorts, pants, and everything trying to do that. But if I am again, I am talking through my bias, right? I need to get over this mental bias of myself to be able to explore that. But I'm slowly, sort of starting to think on those lines. And the objective finally is to have different strategies running together which will make money irrespective of the market, and then I can go and sit and not do anything, and read books or do whatever.
So, Mudit has asked your view on moderate leverage.
My
25
view
to
on
30%.
leverage is don't use leverage. Simple.
Moving on to the next question. So Darshan has actually asked two questions. I'll ask first, how one can improve investing psychology as it's 80% of the game. What are the best resources and how one should go about it?
So Darshan, great question. I think the first and most important thing is there are two things you can do. One is obviously you need to read about different biases. You need to be aware. First of all, most of the time what happens is we're not even aware that we are making a mistake. So first of all, we need to be aware of what biases are there, how they impact you. And second is just be aware of the mistakes you are making and the mistakes that other people are making while investing, right? And the moment you see those mistakes that you're making, write them down and then try to eliminate that in yourself. It's as simple as that. It's a conscious decision, right? So I have simple rules like, I have figured out that the base rate of averaging down is very low compared to averaging up. So I don't average down. I only average up. So that's one way of taking this thing. If there is a loss, I will book my loss. So price anchoring is something that I've taken out that way. So basically, you have to have rules for yourself in place so that you are able to eliminate these biases. Quantitative systems, or I'm not saying you have to become a full-on quant, but having written down rules of buying, selling, etc., even if some of them are a little bit subjective, are better than having no rules at all, right? So that's how it is.
Yeah, thank you. Some really good points over here. So, specifically about writing down the rules.
So the other point I missed the last question. What are the best resources? Lot of books. You can go to my blog.intelsense.com. There's a link called, I think, My Bookshelf. I have listed down all great books that I have I think is worth reading, and I've put it based on categories. So that you will find a category on behavioral finance. You can just go through some of those books.
So his next question, Darshan's next question was, what impact Kolkata as a city has in your investing journey, considering there is a large community of investors and traders there?
I don't think it has played any significant role at all. I think most of my learning, etc., has come from reading. It would have been irrespective of where I was. So I don't think it has made any difference, to be very honest.
Anand has asked a personal question. So maybe, I don't know how comfortable you are in answering this question. So if you can share, what's your portfolio looking like? Fixed income percentage, equity percentage, gold percentage? How much is your equity allocation in long term? How much is in quant? How much is in that your head pick strategy which you have in your account?
So let me quickly.
And do you do mutual funds also?
Okay, so I have not done mutual funds since 2010. I started tracking my own performance since then, and I figured that I was outperforming all the mutual funds. So I said, what's the point in subsidizing or reducing my income by giving somebody else? And I continue till today to track against. In fact, I used to track against HDFC Equity Fund. Prashant Jain just left, so I'll have to figure something else out. But the whole idea is I keep track of that, and the day I see that I'm not able to do as well as a couple of good mutual funds, I will put my money to work there. So you have to be as dispassionate as possible with your own investing, because end of the day you have to be very clear ki objective kya hai. Objective is to make money, right? Objective is not to become gyani, right? For that you read books and do whatever else. Investing objective is to make money. If there is somebody else who is able to make more money than you, give the money over to him, right? So that is my philosophy. As of now, I'm not able to find a good mutual fund who's able to do that. Okay, so while I am telling you of this, I will give you one. We've not talked about stocks, mutual funds, anything, any actionable thing today. I'll share one thing which might be actionable. Uh, Again, disclaimer, not an investment advice. Uh, the China-based mutual funds that I think there's one or two. I think Edelweiss has one. Is beginning to look interesting to me from a purely mean reversion perspective. So, people who are interested in investing outside India for a very small percentage of your equity allocation, you might want to take a look at it. My thesis of China is I think it's been beaten, black and blue over the last 3-4 years. My sense is now they are slowly getting their house in order. Next 2-3 years might be better in terms of returns from them. So if people are looking for external, outside India investments, I think China could be a good option through mutual funds. Okay. So my portfolio fixed income versus equity, I don't have the numbers exactly at the top of my head, but it will be probably 10%, 10-15% would be debt. Everything else is equity. I don't have gold. I have basically one house or one flat that I've bought, which is paid off. I have no loans. That's pretty much it. What else is there? Okay, the other question was allocation. So, so I don't have a very fixed determination between long-term quant hit picks that way, but roughly I would say long-term is 50% and quants and hit pick is 25 approximately.
Srikanth is asking about your views on special situation investing.
So I don't understand what special situations mean. I because of my having been always been a working doing this investing as a secondary activity, I was never into something where I have to be always on my toes, trying to evaluate key, or something on a timely basis. I'm not very interested in that. Now that I have more free time, I evaluate some things, but it's not something that I really enjoy doing much. I mean, ठीक है, X is happening, that is why Y is happening. You buy something and you make 10%. It's not worth the effort for me. Ideally, I look for compounding stocks which end up becoming multi-baggers. So, you buy a good company, hold it for 3, 5, 10, 15, 20 years. It will give you manifold return. That is my primary objective. If you put 50-60% of your portfolio in that and you don't have to use your brain after that, that's the happiest place to be. Other than that, you keep doing your quant and your positional trading, techno funda, etc., etc. That is more to keep yourself, active and doing something.
Yeah. One question related to this, what you have already said. Is it? Are you okay with sharing which stock in your portfolio has been the longest holding period stock?
Difficult to tell you offhand, but PI Industries, Divi's, what else has been there for very long? Bajaj Finance. These I think I've held roughly 10-12 साल हो गया है. And what else is there?
Bajaj Finance also 10-12 साल हो गया है.
हाँ, वो 2010-11 में लिया था शायद. I don't exactly remember, but some period around that. I think 2009 onwards they started doing well, so must be around 2011 and 12ish is when I bought. Divi's, PI. What else has been there? I think Hester has been there for 5-6 years, maybe more. I think Hester has been there for 2013-14 onwards.
Hester, I remember you said in 2013 you bought, so it
That's
would
what I'm
be
saying.
8
13,
years, I guess.
13, 14, that period I would have bought. What else? So okay. So when I say that I bought and I held it, sometimes it means that I've done calibration. So PI Industries, I would have bought, I would have scaled down, I would have scaled up, I would have scaled down. So those kinds of things, graphic equalizer kind of mode I have done. But in general, I've held on a lot of these stocks for many years. अगर अच्छा करना है तो only करना है.
And you were fairly concentrated, 8-10 stocks in your portfolio, not more than that.
No. So my portfolio right now is, I think, 13 stocks. But now I've become more concentrated after I've left my job. But in general, it has been around that 15 to 20.
I think another question from Ramnath is, if given an option to invest in two very good fundamentally strong companies, one is trading at 52-week low on account of temporary bad patch. I think this is a very interesting question. And sector not in flavor and trading at low PE. Another stock at 52-week high and trading at high PE. Which one you would choose?
These kinds of hypothetical questions have no really good answer. But the idea is you should look at companies where the near term meaning next 2-3 years earnings visibility is strong, right? So a fundamentally strong company trading at 52-week low is an oxymoron. होना नहीं चाहिए, right? Unless there is a market-wide fall, right? If it is not the case, then why should a very good company trade at very low value, at 52-week lows? Unless the market in its entire wisdom thinks that the next few quarters, few years is not going to be good, right? Again, you'll have to take a judicious call based on the company, based on its business, your understanding of it, when the turnaround can come. And you'll also have to factor in key turnaround. See, basically in the first instance, you're trying to play a turnaround, right? End of the day, paisa kab banega? Paisa will be there only when the stock price goes up. Everything else is secondary, right? Stock price, when will it go up? It will go up because maybe XYZ thing happens, because earnings will go up, revenue goes up, something is the other things happen. But you as an investor will make money only if the stock price goes up, right? So people who disregard stock price and say, hey, price is not important, price is the most important thing. Even if you are a decadal investor, even if you're a generational investor that you buy and hold for 50 years, even then price is important. Why? Because you will make money only if the price is going up. If the price is not going up, it's a bad investment. I'll give you an example. 10 years I held on to Hindustan Lever. 2000 to 2010, did not make any money. My yield would have been whatever 1% dividend yield, and I think in between they had given some warrants. So my total return in that 10-year period of holding Hindustan Lever would have been, not more than 2-3% CAGR. What good did it do to me? Great company going through a bad patch, I made no money. Right? So वो टेक्स्ट बुक में वो ज्ञानी लोगों का ज्ञान में अच्छा लगता है, पैसा कुछ नहीं बनता उससे. The other part is valuations, whether high or low. You have to get a sense, right? I don't believe in DCFs. I believe in the DCF mindset. But the actual process of doing DCF and filling up Excel sheets is all, waste of time. But you need to have that DCF mindset, where that, valuation will come from, where that growth will come from. Is it going to come from revenue growth? Is it going to come from margins? What is the source of growth? What is the source of profitability? Start thinking like a businessman. So the point I'm trying to make is that these kinds of questions have no clear-cut answers. You will have to figure out based on that particular case. right? And whichever at that point in time looks to be a better opportunity. Okay, so I'll give you a live example. Last year, I picked, I think, Elecon engineering for my advisory. At that point in time, there was no tailwind for engineering cap goods. They were all beaten down. Nobody was interested. But I could see what prompted me to buy Elecon was I could see that the trajectory of their debt was coming down, which obviously meant that the moment you start paying off debt, incremental revenues is going to fall through directly into your profitability. So profitability is going to go up significantly. That was the easy part. And then you could sense that this PLI schemes, a lot of these private capex is coming up, and you cannot put up a cement plant, you cannot put up a sugar plant, you cannot put up a large ethanol plant without having a uh, industrial gearbox. So to me, it was a very intuitive kind of call. Now, I did not know whether it will play out in 6 months or 1 year or 2 years, but I was ready to wait for that period. I was lucky that it started playing out after few months, but the wait could have been longer, right? Now, another example I'll give you, again, a stock that we've recommended is Cummins. It has not done well in the last 6 months. Luckily, also, it has not fallen also with the market. The market has fallen, it has not fallen, but it has not done well also. But my thesis is the reason why I bought it, that these are the only large players who are playing the data center game. And you cannot have data centers, you cannot have hospitals, you cannot have malls or whatever, large residential complexes without having backup power. India does not have the quality of power today that you can do away with generators, right? So you will get these initial hiccups where people will question that क्या है, ये तो non green है, ये है वो है. But the fact is that they are required. When that transition needs to happen from non green to green, they are the best placed because they are far ahead of the others in terms of technology. Okay, another mistake, and I'm going off track a little bit here, but I think this is important, is a lot of times I used to think previously, no, I will not buy this because if this happens, XYZ happens, then it will go wrong. I will not buy this company because this has a, single person concentration. And if this person, key man risk, if this person dies, then what will happen? Over the years, I figured out that those things sometimes doesn't even play out for a decade, and you missed a 20 bagger. So now my theory is that is not my company. If what I'm thinking as a risk, if it plays out, I'll sell. What is there? Right. So that is the way I think you'll have to take the call on an individual basis.
That was very, very, very interesting. I think one of the best part of the interview today, how you look at different companies and how you look at the risk. So many a times we get lost in what has happened in the past, or as in, even if the management has not done something really good in the past, say 10 years ago, 15 years ago, and it keeps on creating a cloud in our mind. And even though the management has changed its stance, even though the industry tailwind has kicked in, but we keep living in the past and we make that kind of misjudgment. In fact, I have done that many a time, so I can share that.
Correct.
So the next question is from Rahil. Your view on which 2-3 sector which looks good for the
so
next
Rahil,
2-3
I've
years?
been I've been saying this over last few months, maybe a little bit more. I think real estate, we are seeing definite pickup. We're seeing I think we are going to see a revival in capital goods engineering. Autos definitely starting to look very good. I think overall consumption is going to come back again. My sense is next 3 years, is going to be really good for India. That's my sense. I could be wrong. And I have quoted, I have cloned what RJ keeps saying. I reserve the right to be wrong. I think that's a fantastic, way to put it. But I think next 3 next 3 to 4 years is going to be really, really good. We could actually also be at the cusp of an, very strong, sustained, business cycle in India, because China plus one and all of these things are very long-term trends. These are not something which is going to happen in the next 6 months, but this is going to happen surely, and definitely it will happen, and it will take a lot of businesses to levels which we are not able to even think of today. So if you have the money, you have to be invested in the markets. If you don't have the money, get the money from somewhere and get invested in Indian markets. I think that is the bottom line. Next few years should be very good in the way I'm thinking. Let's see.
Right. So one question is from Anand. Is it a good time to start deploying extra cash, say 30% of cash to portfolio, or does your quant technical evaluation suggest there might be substantial drawdowns on Nifty?
So
First,
the answer to that question is there is no model, there is no technical analysis, there is no analysis in the world which will tell you what will happen tomorrow. Right? Any technical analyst who comes and tells you that this is going to happen tomorrow is basically a charlatan trying to sell you something. Right? All analysis is basically a look back. You are looking behind. Fundamental analysis, you are looking behind. Technical analysis, you are looking behind. You are looking at what has happened in the past. You're trying to figuring out patterns from there, whether it is fundamental patterns or technical patterns, and you're trying to project probabilistically what might happen in the future. Nobody knows for sure. Right? So that's the first answer to your question. Second answer is, when is a good time to invest? In my opinion, if you have the money which you do not need for the next 4-5 years, now is the time to invest, and that now is constant. It will always be now is the best time to invest. Right? Provided you don't need the money immediately, because again, if you invest after 6 months and the following day the market crashes, right? What can you do? Nobody can talk about that. Ultimately, if you don't need the money, if you have additional capital, keep investing, keep doing an SIP, spread it out. If you think the market is too volatile, spread it out over 2 months, 3 months. See, end of the day, think about your time horizon. If you are investing in the market for the next 20-30 years, how is it going to make a difference whether you're going to buy at Nifty at 16,200 versus 15,500 or 17,500? What big difference will it make to your life after? What was the value of Nifty 10 years back? Right. Nobody remembers also, right? I remember when I started, first year, I think 2000, Nifty first time went above 1,000. CNBC TV18, then I think it was called TV18 then only or something else. They had a big cake cutting and all there for Nifty 1,000. Today it is a 16,000 whatever. How does it make a difference? 10, 15, 20 years if you're investing for, all this will be in error, right? You don't even remember. See, I don't even remember whether I bought Bajaj Finance at 20 rupees or 25 rupees or 30 rupees. But between 20 and 30, at that point in time, was a 50% difference. Think about it. 20 and 30, there's a difference of 50%. Today, if it is at 8,000 and I ask you to buy at 12,000, there is a 50% difference. People will get scared. Yaar, 50% to bhag gaya upar. If it is able to compound the way it is able to compound today, 20 years later, at adjusted price, it might be 5 lakhs. Then you will not remember कि 8,000 पे लिया था कि 10,000 पे लिया था कि 12,000 पे लिया था. क्या फर्क पड़ता है?
Right. So
last point. So the point you have to remember in creating big money, getting the right business is more important. If you can get a Bajaj Finance and you are able to sit through the ups and downs, that is more important than trying to nitpick and say, yaar, maine exactly ye point pe diya. That exact point is required if you are doing trading. Because then you're playing with that 10-15%, right? That is 20%, 30% return is what you're looking for. If you are looking for 1,000% return, then you are playing a different game. So you have to understand what game you are playing.
Right. And so I'm glad that you put this thing in this way. So many people think quants मतलब ही आप short term trading वो सब की बात कर रहे होगे. But when you apply that quantitative mindset and then also marry it with your long term thinking, I think this becomes a very good potent.
Yeah, so that is what helped me also. See, when I started doing Techno Funda or started doing quant, a lot of the learnings I've been able to, bring back to my long-term investing as well, right? Which has helped me a lot in terms of maybe a slightly better timing, right? Previously, kya hota tha ki I used to find a good stock and I used to start buying, accumulating, and that waiting period would have been a year, 2 years. Now I wait and I say, ठीक है, let other people do the grunt work first. Thoda to let it run a little bit and then I'll buy. What is the big deal? So I'm then sort of following the trend a little bit. So, but in effect, what is happening is that the CAGR will go up because you're trying to reduce your waiting period. So those are things that you try to learn and try to improve your process. That's the whole thing.
Yeah, one last question, Abhishek. This is from our Mission Smile member Avdut, and he actually asked me a few days back, but I thought that it would be better if he asks this himself. So I'm unmuting him. Avdut, you can go ahead.
Hi, good afternoon. Abhishek, thanks for taking time and giving us insights into your journey, and it has been very helpful for us. Two questions. These are different from which I asked Ankit Bhai, but during your session I came across. So this fear you mentioned about allocating capital initially, coming from middle class background, I also have this fear about allocating higher capital in initial go. So how do you come over it over the period and how it evolved? That's first. And second question is about you. You mentioned about 80% is all about behavior. I do agree with it. And how you changed your journey into the behavioral things and how it reflected into the returns profile gradually. That two things I would like to know. Thank you.
So the behavioral thing, let me talk about it first. Behavioral thing is, again, you keep learning, you keep introspecting, and you try to evolve your process. There is no easy solution to it, right? There is no magic bullet that you can say कि नहीं ये करने से हो जाएगा. It's not going to be like that. And to be very honest, the difference between a average, a good investor and a great investor is about the way they are able to handle themselves, right? In my mind, that is the biggest difference, right? There is no magic bullet. There's nothing that I can tell you that will help you to get better at it. You have to learn, you have to read, you have to introspect, you have to learn from your own mistakes. That's what it is. There is no easier way out. So that is the answer to your second question. The first question, I think, is, see, when I started, I had no money, right? My salary was 10,166 rupees. I used to stay in a rented flat in Pune with three other friends. We used to share a flat. Our total expense used to come to around 4,000-5,000 rupees. So 5,000 rupees बचता था, वो I used to put in the market. And that is how it all started. That continued. So in a way, it was good because there was no lump sum of capital at any point in time that I was afraid to lose. So that is one. Second is, when I started having more money, by that time I had already understood that equities will make me rich. So then that fear went away, right? even today, in fact, from the year 2000 till today, my equity portfolio has been a one-way street, right? I've never taken a single rupee out. It has only gone in, and last, I think, 10 years, I have not even put money in also. Not 10 years, last 7-8 years, I have not put additional money in. So it's just sort of compounded itself. The way of getting out of this fear is, one, you have to have that conviction, and second is go slow. If you have a lump sum of capital, you don't have to put it in one go, right? You decide that I will, spread it out over 2 years. So every month, do a little bit of SIP over the next 2 years. And do it slowly. Basically, see, if you put in 100 rupees and that 100 goes to 110 or 120, automatically that fear reduces, right? So that part is very clear.
If I may just add here, is that what Abhishek wants to say here is that there is no shortcut here. So it took him 20 years to reach this stage. So when you start small, you can really do big and very well, and you can become financially free, as he mentions that he's financially free, but it will take its time. So it will take at least 15 years.
It cannot, nothing, Sachin Tendulkar did not become Sachin Tendulkar overnight. So exactly. That morning 5 o'clock net practice you have to do, that slogging you have to do. There is no easy way out. And why I keep repeating about sports is, one is I'm passionate about sports, and second is that sports and the markets, investing is very similar. You can see results immediately. You can keep improving your skill. So a lot of similarities are there. It's exactly like in the markets, in sports also. You have to put in the time. You have to put in the effort. Only then you will get returns. No matter how talented you are, you can be a great talented player and then end up becoming like a Vinod Kambli.
Right. So I think we have covered almost all the questions of the audience till now. So Abhishek da, if you have a few minutes available, I would like to continue with my questions, if that's okay with you.
This is already 2.5 hours, so nobody is going to be around, I think.
It's there. There are still 40 people. So, okay. And anyways, we are going to record and it will be available for all.
I don't have a problem.
Just that if you are okay, right?
Okay.
Right. So this question might look like a little controversial, but I'm not making any controversy here. It's a very relevant question. And I think all of us here will agree with me over here. So Buffett and Munger has been a role model for many, including us at Mission Smile and Smart Sync Services. However, there is a fine line between considering someone as a mentor or God, right? So taking no credit away from what they have done for the whole investing community in the world, where do you think an average investor like me is prone to getting it wrong when it comes to following the great investors like Buffett or Munger, or for that matter, anyone else?
So first thing is, don't follow anyone blindly. Right? Always question, always be ready to look for disconfirming evidence. That, see, talk is cheap. Anybody can come and say anything. I can come and say all great things. But end of the day, if I am not following what I'm saying, there's no point. You will find so many people, so many great, investors, so-called quote unquote fund managers, coming and saying so many things on television. You go back and look at their track records, and you will see that that track record is very, very mediocre. Right? So what is the point? So the thing is that you have to be very choosy. You have to question what people are saying versus what they are doing, and you have to ultimately bring it back to what you think and what your mindset is. That is very important, right? If you are a trader by nature, reading a lot of Buffett is ultimately going to be harmful for you. You are better off reading a Mark Minervini or a Van Tharp or somebody else. That's the point. And vice versa. If you are a deep value guy, and somebody keeps telling you, "Nahi, Mark Minervini padho," or Elder Alexander Elder padho, you'll feel that it's disconnected.
Right, right. So now, in the Indian stock market, whom do you consider in high regards? A few names and reasons why you follow them more.
To be very, very honest, I don't think there is any perfect investor in India or anywhere. So I have a lot of respect for a lot of investors. I think all the usual suspects like Rakesh Jhunjhunwala, Ramesh Damani, Vijay Kedia, all of them, and I think even people like Hitesh Bhai from Value Picker. I think he's very good. Anand Jain, a lot of Value Picker folks. Rupesh is doing very good work. Donald is very good. Dhwanil is very good. Ankit, a lot of these Value Picker guys are actually very, very good investors. Some of them, in my opinion, are better than some of the bigger names that come on TV. Their networks may not be very high, because all of us have that challenge of having started very small. But there are a lot of very good investors out there.
Right. So another fascinating point which I learned from you was this: knowing what kind of a person you are and having clarity of what you want to achieve. So I think I wanted to ask you on the three different aspects of your life right now. So, as in, how do you look at, so from an investing perspective, if I forget about everything, and from an investing perspective, how important it is right now to have to know these two things, knowing what kind of a person you are and having clarity of what you want to achieve. So would you like to say something
See,
more on this?
ultimately, you have to be clear about what is your objective. Why are you investing? Right? That part needs to be clear. What is your time frame? So these are the fundamental questions you need to have answers to. Right? If you know that I am a long-term investor, you'll behave differently. If you are playing test cricket versus T20, you will bat in a different manner. Right? So these are the basic things. Right? Once you understand who you are, what drives you. Right? There are some people who are very comfortable buying a stock at very low prices, and for that stock not doing anything for many years and then going up 10x. There are some people who are afraid of making losses. There are some people who so different kinds of people. You have to figure out what kind you are, what energizes you, what works for you, and then tailor make your investing style based on that.
Right. So now quickly, last two questions. I'll not take much of your time. So now we have covered your past, we have covered your what you are doing today. I'll just try to probe some questions as to and ask you to just look at your life 3 to 5 years from now. Of course, nobody can predict, right? We all can only speculate. As investors also, we think that investors are not speculators, but we also speculate about the future. Maybe our time frame is maybe the horizon is a little longer, right? So I want to know from you how you are preparing for your future in terms of three things. Number one would be your professional career in investing, which is you started as an advisory, then recently you started a PMS. Big congratulations again for the same, and our best wishes as always. But what next? So that is number one. Number two would be your journey as an investor. How do you see yourself, say 3 to 5 years from now? What Abhishek of today would want to say 5 years from now? I mean, what addition or subtraction you would
So
do to
the
your...
answer to both your questions is actually the same. So the answer basically is, now I want to solve for my own happiness and satisfaction, right? Work happiness, work satisfaction. Now, what do I mean by that is, now I want to work on things which energizes me, which makes me happy, which makes me, curious, those kinds of things. And the advisory or the PMS or whatever, those are vehicles that is going to be, there. uh, the PMS started more because the advisory clients kept coming back and saying that why don't you have a PMS. So it's not a conscious kind of this thing progression. The whole idea is to work on things which interest me, related to investing. uh, I don't know. I honestly don't know what path it will take in the future. Uh, but probably a combination of all of these things that I'm doing today. Uh, Trying to probably spend a little bit more time on uh, uh, improving the processes, improving my own thought process. Uh, Always had a dream of writing a book. I've had two, three offers to write a book. I've not even contemplated them, simply because I don't think I've reached a stage where I can uh, get to a point where I can write a book. But definitely, writing is something which I really like. Uh, so writing more, whether it's for ET or whether it's for my own blog, writing more for my own clarity, that is something that I'm looking forward to. Nowadays, my all my nephews, nieces, and all the younger people in generation, my friends' kids, they are all now this is a very interesting thing. Now they are seeing this one person, uh, who's their dad's friend or who's there in the family, koi mama hai, chacha, whatever, and they're seeing that okay, this guy has been able to do well in investing. So all of the younger kids in the generation, people who've started working, they're all now starting to invest. All of them are coming to me, taking suggestions, advice, whatever. So that I think has been very satisfying. And what now the feedback that they are giving me is कि why don't you do YouTube videos? Because यार कौन उतना पढ़ता है आप, you keep writing, why don't you speak? It's easier for us. So maybe, whatever I'm writing, see, I personally enjoy the process of writing, so I'll probably write and maybe also speak it out in a video or something like that. But those are semantics, right? Uh, the whole idea is to now do more of what I increasingly enjoy doing. So starting to learn machine learning, trying to use that, trying to see if how much of it can be used. Uh, that I mean, trying to learn new things. That's the whole thing. You know, keeping your mind fresh.
So, last question would be: you have made a great list of books on your website and categorized them. That is the best part. Actually, you have categorized them into different topics as to if you want to learn about growth investing, if you want to learn about technicals, if you want to learn about valuation. So that's a very good part of your website. However, if I have to ask you top 3 books which you may reread today or even in the future as well, which ones would they be? Top 2 or 3?
Very for me or for somebody who's
You
beginning.
can
For me, it
you
will
can
be
answer
different.
it. Okay.
So I'll give you
You
both.
can
So
answer.
yeah.
Give
So
both.
if I have to reread books, I will probably reread Beating the Street, Peter Lynch ka, because that's a case study kind of a book. I'll reread Common Stocks and Uncommon Profits, Phil Fisher, and I will reread Poor Charlie's Almanac, which I think if you make a little bit of money from the markets, you should spend that 5,000-7,000 rupees to buy that book, right? And read it at least, read one chapter every few months. I consider Charlie Munger to be my grandfather, in the sense that he's the person. My grandfather passed away before I was born. My dad's dad. So I consider Munger to. in his position. So whenever I have a question in my mind, whenever I have a doubt, I have to think through what should I do. I think about, what would Munger say. So pretty much I've read, heard everything that that old man had to say. If you want to lead a good life uh, through troubles, through different these things, I think Munger is the guy to read and listen to. Although my next article probably will be on the mistakes that Munger has made. Uh, so, so the whole idea again is never to sort of idealize anybody, but yeah, these three other books I would reread for people who are starting off in the earlier phase of their journey. I think One Up on Wall Street would be very, very useful. Then maybe Expectations Investing would be very useful. And what else? Probably Poor Charlie's Almanac. These three would be the books I would recommend people to read.
Throughout this whole interview, Abhishek, while I was listening to you, I couldn't find any similarity. I was just, it was, so one thought which was all constantly running in my mind was that, okay, this is something which I have to learn. Okay, this is something which I have to learn. Only in this segment, I can maybe boast of that I'm very similar to you. So I have read Common Stock, Uncommon Profits maybe more than 20 times. I've not kept a count, but this is one of the most underrated book in my sense. People don't talk about it much today. It used to be talked about much earlier, but आज के दिन लोग बोलते तो है, but I don't see people writing anything related to it or discussing about those. Scuttlebutt has been a very important part of investing and being, but ये book के बारे में ज़्यादा I don't hear from investors is what I can say.
Or I think proper growth investing का best book है ये. There's no
exactly. Right. And similarly, the other part was so when I talk to my 7-year-old son, I also keep referring it to Charlie Dadu. I don't say Charlie Munger. So that is one similarity I got for the whole interview. With this, I'll just ask you to just give your one final remark or piece of advice for our Mission Smile family and SmartSync services, if you may.
So there's no advice. I'm not in a position to advise people, but I think one thing is, just like the name said, smile. I think that is very important for all of us. Trying to be happy in whatever we do, whether it's work, whether it's personal life, whether it's trying to derive satisfaction, peace, and being helpful and trying to contribute back to society. I think I'm not trying to be political, but I think as a society, not only in India today, but I think the world today, we've become a lot more self-centered. I think the world would probably be a much better place if we think of giving back a little bit, whether it's in just watering a plant or something small. It need not always talk about money, but even small things, gestures to people. I think that I think trying to be a good person along with being a good investor is, I think, probably the most important thing for all of us to strive.
Thank you so much, Abhishek. I think that I've not heard any better advice. So you might have started with saying that I'm not in a position to advise, but I personally liked your advice, and I think in a way everyone has that kind of a pursuit. Deep down, everyone wants to be a better human being, right? It's just that we don't follow that consciously.
पता नहीं यार, newspaper पढ़ के तो लगता नहीं है. I've stopped reading newspapers 2-3 years back. It's so depressing.
So that has to do with incentives. So
yeah,
they know that negative sells much faster than positive. So that might be the reason. But deep down, I think all human beings want to be a better human being over a period of time. It's just that we get lost in our track. Right.
Correct.
Thank you so much.
Thank you.
It has been really good session, and it goes to show that so many people stayed back even after the 2 hours were crossed. So right now, I think we have spent more than 2 hours 40 minutes, and it never felt like that. It's becoming too long, at least for me. So thank you so much for your
Thank
time.
you.
It's priceless. I hope we keep learning from you, and
Thank you so much.
wish you
Thank
all
you.
the best in whatever you do in your life, in your investing, for your advisory services and PMS.
Thank you
And
so much.
I'll be in touch with you as
Sure.
always. Yeah. Thank you. Thank
Sure.
you so
Thank you
much.
so much. Thank you.
And
Thanks a lot.
thank you so much, audience, for being there and listening and asking some really good questions. Thank you, everyone. Bye.